In this chapter, we focus on management control systems and transfer pricing, especially in the context of multinational organizations. The central question we're addressing is how organizations can design control systems that effectively motivate managers, support overall strategy, and establish transfer prices that improve company-wide outcomes. We'll explore how elements like strategy, decentralization, and transfer pricing influence decision-making across global operations. Understanding these connections is crucial for aligning goals and optimizing performance throughout diverse organizational units. When we look at the fundamental properties of a management control system, the first key point is that it supports strategic alignment. This means the system is designed to guide decisions so they align with the overall strategy of the organization, not just the goals of individual departments or units. This ensures everyone is moving in the same direction. The second property is that the system influences behavior. Through measures, incentives, and reporting, it shapes how managers and employees act, especially in decentralized organizations where people have a lot of autonomy. This behavior alignment is crucial for organizational success. Finally, a management control system relies heavily on accounting information. Having timely and relevant performance data allows managers to plan effectively, coordinate activities, evaluate results, and make necessary adjustments. This continuous feedback loop helps keep the organization on track toward its objectives. On this slide, we're looking at three crucial elements that work together within management control systems: strategy, organizational structure, and accounting information. First, strategy is all about defining priorities and making competitive choices. It sets the overall direction and outlines the behaviors managers are expected to exhibit. Next, organizational structure comes into play. It allocates decision rights across different units. This shapes how coordination, autonomy, and accountability are managed within the organization. Finally, accounting information is vital because it measures performance, supports decision-making, and provides feedback by showing whether actions align with strategic goals. When these three elements reinforce each other effectively, control systems operate smoothly and support organizational success. In this chapter, we make the case for decentralization by looking at how distributing decision rights can enhance overall performance. The key is ensuring that the benefits outweigh any control challenges that come with it. One major benefit is that local knowledge allows decisions to be tailored more closely to customers, suppliers, and specific operations. This proximity means the units can respond faster without needing to wait for approval from headquarters, which speeds up action and adaptability. Decentralization also plays a crucial role in developing managers. By giving them more responsibility and autonomy, it builds their initiative, accountability, and strengthens leadership depth across the organization. However, there are some costs to consider. When divisions focus too much on local goals, they may create conflicts with the company's overall objectives, leading to goal incongruence. There can also be duplication of resources, as similar functions or systems might be repeated in different units. Finally, decentralization makes coordination more complex, especially when it comes to managing control systems, setting transfer prices, and evaluating performance across units. Balancing these factors is critical to making decentralization work effectively. Now let's talk about the benefits of decentralization. One major advantage is faster decisions. When managers who are closest to the day-to-day operations have the authority to make decisions, they can respond much more quickly to customers, competitors, and local conditions. This agility is crucial in today's fast-paced market. Another benefit is sharper local insight. By keeping decision-making authority with the people who really understand the specific market, the organization can be more relevant and adaptable to regional needs. This means strategies are tailored more effectively, which often leads to better results. Additionally, decentralization supports stronger manager development. When managers have decision rights, it encourages initiative and accountability. This not only builds leadership skills but also creates a deeper pool of capable leaders throughout the company, preparing the organization for future challenges. These points are essential to understanding why decentralization is so valuable in managing operations across diverse markets and environments. Now let's look at the costs associated with decentralization. First, duplicate activities can arise because separate units might end up recreating the same staff, systems, or expertise independently, which leads to inefficiencies. Then, we have weaker coordination. When decisions are made at the division level, they can overlook important dependencies and timing issues that affect other units. Another key challenge is goal incongruence, where local managers focus on optimizing their division's profit rather than the overall company's profit, which can create misaligned objectives. Information costs also increase, making it more difficult to accurately measure performance and manage transfer pricing across divisions. All these factors highlight some of the management control complexities and multinational considerations companies must address when decentralizing. A transfer price is essentially the amount one part of a company charges another part for goods or services. This internal pricing is really important because it directly impacts divisional profits, influences manager incentives, and plays a role in company-wide decision-making. For example, in a manufacturing setting, a parts division might sell motors to an assembly division, and the price set for those motors is the transfer price. Similarly, shared services like corporate IT might charge regional units for system support, which is another form of transfer pricing. On a larger scale, in multinational companies, transfer prices come into play when, say, a U.S. subsidiary transfers products to a European subsidiary. Understanding these flows and pricing mechanisms is key to effectively managing control systems and making informed decisions across the entire organization. When evaluating transfer prices, there are 4 key criteria that help ensure the price is effective for both the firm and its managers. First, goal congruence is essential. It means the transfer price should encourage decisions that maximize the company's overall profit, aligning everyone's interests. Second, management effort is important. The transfer price should motivate managers to put in high effort and exercise sound judgment, driving better performance. Third, subunit performance must be assessed fairly. The transfer price should provide credible measures so each division's performance can be evaluated transparently and accurately. Finally, subunit autonomy needs to be preserved, allowing divisions to make decisions independently without constant oversight from higher management. Balancing these 4 criteria helps create a strong transfer pricing system that supports both decentralized control and overall company success. When it comes to calculating transfer prices, there are 3 main methods we typically consider. First is the market-based approach, where the transfer price is set equal to the external market price. This method works well when there's a competitive outside market for the product, making the price clear and objective. Next, we have the cost-based method, where the transfer price can be based on the variable cost, the full cost, or the cost plus a markup. The choice here largely depends on the company's internal policies and what makes sense for their management goals. Finally, there's the negotiated method. In this case, the buying and selling divisions agree on a transfer price within a feasible range, which allows for some flexibility and collaboration between departments. Each method has its own advantages depending on the company's structure and external market conditions. Now, let's talk about market-based transfer prices and why they work effectively. When divisions within a company operate in perfectly competitive markets, the external market prices serve as a benchmark. This means that the prices set for internal transfers between divisions align the incentives of each division with the overall goals of the company. Essentially, by using market prices for internal trading, the company ensures that the divisions behave as if they were engaging in transactions with outside parties. This alignment helps promote efficiency and fairness in internal exchanges, making sure that the economics of these transfers reflect real market conditions. This approach is particularly important in the context of management control systems and transfer pricing, especially when dealing with multinational considerations. It keeps everyone focused on value creation and performance that benefits the entire organization. In this slide, we're looking at the risks that come with cost-plus transfer pricing. The main issue here is that when a markup is added to total cost, it can make internal transfers seem more expensive than they actually are. This might lead the buying division to turn to outside suppliers, even when it would be better for the company as a whole to buy internally. The problem really boils down to the markup pushing the transfer price above the seller's relevant cost. This can distort decisions and reduce overall company profit. The solution is to focus on incremental cost and capacity information rather than the full cost plus markup. If the selling division has unused capacity, the transfer should be evaluated based on variable cost and the contribution to the company overall. Then, the actual transfer price can be negotiated separately. This approach helps align decisions with what's best for the entire company, not just individual divisions. When there is unused capacity, it actually expands the feasible transfer price range between the seller's minimum price and the buyer's maximum price. The key idea here is that because no sales to external customers are being displaced, the seller doesn't lose any contribution margin by transferring the product internally. This means the seller's floor price is essentially the incremental cost to produce the unit, which is the lowest acceptable price. On the other hand, the buyer's ceiling price is the market price they would pay to an outside supplier, representing the highest price they should be willing to pay. Since no external sales are affected, the transfer price can be negotiated anywhere within this range, allowing both parties to benefit without negatively impacting their respective costs or revenues. This concept is critical in management control systems and is especially important when considering transfer pricing in multinational organizations. When arriving at a hybrid transfer price, firms often can't rely on just one method. Instead, they combine approaches to find a price that aligns with capacity, incentives, and divisional autonomy. First, negotiation is key. You start by discussing a price within the feasible range, ensuring both parties have room to reach agreement. Next, adjusting the cost-plus method helps to remove distortions caused by idle capacity. This keeps the price more accurate and fair. Third, using dual pricing allows the seller to be rewarded appropriately while still protecting the buyer's interests, striking a balance between the two sides. Finally, setting the hybrid price involves balancing goal congruence, autonomy, and tax considerations to meet the overall objectives of the organization. This combination helps create an effective and practical transfer pricing strategy. Now, let's take a closer look at the general guideline for determining the minimum transfer price. The minimum transfer price is calculated by adding two key components, the incremental cost per unit and the opportunity cost per unit. Incremental cost usually refers to the variable cost involved in producing and transferring one additional unit internally within the company. It's the direct extra cost incurred for that unit. Opportunity cost, on the other hand, represents the contribution margin lost if the selling division forgoes an external sale to transfer the product internally. This is important because the division might sacrifice profitable external sales to meet internal demand. When the company has idle capacity, the opportunity cost is often zero. In such cases, the minimum transfer price simplifies to just the incremental cost, since there's no lost external profit to consider. From a managerial perspective, using this formula helps prevent internal transfers that could damage either the performance of individual divisions or the overall company profit. It ensures that transfer pricing decisions promote sound financial management across the organization. Now, let's delve into income tax considerations in transfer pricing. Transfer prices are crucial because they determine where profits are reported and, consequently, where taxes are paid. For multinational companies, it's a delicate balancing act. They need to minimize their overall tax burden while also aligning with the operational realities across different countries. Tax authorities worldwide expect transfer prices to reflect arm's-length standards, meaning prices should be consistent with what independent parties would agree upon in similar transactions. To support this, companies must provide comparable market evidence. If transfer pricing is set poorly, it can lead to significant risks, including audits, penalties, double taxation, and even problematic incentives within company divisions. So, understanding the relationship between management control systems, transfer pricing, and the multinational environment is critical for effective and compliant tax planning. In this chapter, we're focusing on transfer price optimization across tax jurisdictions. Tax planning often involves shifting profits between countries to minimize tax liabilities, but aggressive pricing strategies can lead to significant regulatory and ethical risks. One of the main risks is tax exposure. Tax authorities expect transfer prices to reflect what independent parties would agree upon in similar market conditions. This is known as the arm's length principle. If prices don't align with this standard, authorities may reject them. Another risk comes from documentation gaps. If companies can't adequately support their pricing methods, they face audits, penalties, and potentially costly retroactive tax adjustments. Then there's the problem of double taxation. When one country increases taxable income without a corresponding reduction in the other, companies end up taxed twice on the same income. To manage these risks, several compliance strategies are essential. First, use defensible benchmarks. This means anchoring transfer prices to comparable market data, thorough cost analyses, or accepted tax guidelines. Second, maintain contemporaneous support. Document all assumptions, business functions, risks, and pricing logic thoroughly before tax authorities ask for it. Finally, align global policy by coordinating across tax, finance, and operations teams to ensure that efforts to optimize taxes never compromise compliance. By carefully balancing these factors, organizations can optimize transfer pricing effectively while mitigating potential regulatory challenges. On this slide, we focus on the key takeaways related to management control systems. First, it's important to understand that these systems guide behavior by aligning managerial decisions with the overall organizational strategy, rather than just focusing on financial outcomes. This alignment ensures that day-to-day actions support long-term goals. Next, control systems need to fit both the organization's strategy and its structure. Different roles and responsibilities demand different performance measures and information flows to be effective. This means there's no one-size-fits-all approach. The control mechanism must be tailored to the context. We also see that decentralization plays a significant role. By pushing decision-making authority closer to where the knowledge, customers, and operations are, organizations can become more responsive and adaptive. However, this increased decentralization comes with its own challenges, such as coordination difficulties, inconsistent decisions among units, and potential conflicts in goals across the company. Accounting information is a crucial tool within management control systems. It helps managers evaluate how well units are performing, motivates necessary actions, and supports aligning everyone's efforts toward shared company objectives. Lastly, we touch on the relationship between management control systems, transfer pricing, and multinational considerations. These factors add layers of complexity that managers must navigate to ensure effective control across diverse operations. Overall, these points underscore the importance of designing control systems that are strategic, flexible, and well integrated with organizational structure. When it comes to setting transfer prices, there are three main methods, each suited to different situations. First, the market-based method sets the transfer price equal to the external market price. This works best when there's a competitive market because it aligns the goals of different divisions and supports managerial autonomy. Next, the cost-based method uses variable cost, full cost, or cost plus a markup to determine the price. This method is valuable when no reliable market price exists, although the markup can sometimes create distorted incentives. Finally, the negotiated method allows managers to agree on a transfer price within a feasible range. This approach is most effective when managers have good information and bargaining power, especially if there is unused capacity. Understanding these methods helps ensure transfer pricing supports the company's overall objectives and operational realities. In this chapter, we're focusing on how strategy, organizational structure, and control mechanisms come together to drive effective management. The key idea here is alignment, making sure that the company's overall strategy, the way it's structured, and the transfer pricing policies all push managers toward the same goal. When these elements work in harmony, control becomes much more effective because everyone is moving in the same direction. We'll also delve into management control systems and how transfer pricing functions, especially in the context of multinational companies where things get a bit more complex due to different markets and regulations. Understanding how these pieces fit together is essential for ensuring that the company's objectives are met efficiently and cohesively. When we think about decision framing in transfer pricing, it's crucial to start by understanding the behavior that the price will drive. The first key question is whether the transfer price aligns divisional incentives with the overall company's profit goals. We want to make sure that each division's objectives support the larger corporate strategy. Next, we need to ask if there's a reliable external market price to guide us, or if we're setting a transfer price without a true benchmark. This matters because market conditions can vary, and depending on those changes, the transfer price might need to serve different purposes, like disciplining divisions, encouraging negotiation, or simply approximating external prices. The third question focuses on costs. Which costs are actually relevant at the margin, especially when there's idle capacity? This helps ensure that prices reflect the real economic impact of the transfer. Finally, we consider how other factors, like tax regulations, the autonomy of divisions, and how performance is evaluated, will influence the final price. All these elements together shape a transfer pricing approach that supports both management control and multinational considerations effectively. When we talk about multinational transfer pricing in practice, the key challenge isn't about finding one correct price for internal transactions. Instead, it's about aligning pricing strategy across different countries with varying tax rules and business environments. Companies have to carefully balance several factors. Transfer prices need to support effective management control systems, so divisions are evaluated fairly on their performance. At the same time, these prices must comply with tax regulations to avoid penalties and minimize overall tax liabilities. Customs duties and cross-border trade considerations also play a role, adding complexity to setting prices. Ultimately, it's a delicate balancing act because divisions in different countries may have conflicting local incentives, yet the company must coordinate them to achieve global strategic goals. Now, let's dive into some common pitfalls in transfer price setting that can really throw off company performance if we're not careful. First, ignoring opportunity cost is a big mistake. Setting a low internal price might seem efficient on the surface, but it can actually prevent profitable external sales. The better approach is to factor in the contribution margin lost, especially when our capacity is limited, so decisions reflect true economic cost. Next, applying cost-plus pricing mechanically can also lead us astray. Just adding a markup to total cost might encourage buyers to make choices that hurt overall company profit. Instead, we need to check if our pricing rule supports goal congruence, meaning it aligns the incentives of different parts of the business with the wider company goals, before adopting it. Another common issue arises from misaligned divisional incentives. Managers might focus solely on maximizing their own segment's results rather than what's best for the whole company. To fix this, we need to design performance measures that align with shared objectives, ensuring everyone pulls in the same direction. Lastly, overlooking tax and regulatory constraints can create serious compliance risks. A transfer price that looks good internally could trigger regulatory scrutiny or tax problems in different jurisdictions. The key here is to balance tax planning carefully while ensuring we stick to arm's-length principles and maintain consistent policies. By being mindful of these pitfalls and applying these best practices, we can improve decision-making and enhance overall company performance. To wrap up, let's review the 6 key learning objectives from this chapter on management control systems and transfer pricing. First, we defined what management control systems are and explored their essential characteristics. Next, we examined the advantages and disadvantages of decentralization so we can better understand when it's appropriate. Then, we dived into transfer pricing, learning how to evaluate different prices using 4 important criteria. We also applied various pricing methods, including market-based, cost-based, and negotiated approaches, to see how they work in practice. In addition, we discussed how to set prices that are both feasible and minimal, while avoiding decisions that might lead to negative outcomes. Finally, we considered how income tax effects influence transfer pricing, especially for multinational companies operating across borders. These core concepts are crucial for effective management and strategic decision-making in complex organizations.